بداية ندواتنا راح تكون مع شركة فونتبل أسيت مانجمنت السويسرية. فونتبل السنة هذه تحتفل في مرور على تأسيس شركتهم 100 سنة ما شاء الله، وعندهم إدارة أصول بما قيمة 250 مليار يو اس دولارز، وإدارتهم تنقسم إلى الأسهم والسندات. قطاع الأسهم هم أكثر خلينا نقول متخصصين بعد في إدارة الأسواق الناشئة اللي هو الإميرجينج ماركتس، وعندهم مكتبهم الرئيسي الهيد كوارترز موجود بزيورخ، وعندهم مكتبهم الثاني موجود في هونغ كونغ. شركة فونتبل هي شركة عائلية ومملوكة 51% من العائلة فونتبل، وهي خلينا نقول 49% ليستد في السوق السويسري. والحين راح نتكلم عن تقريبا emerging market ex China، لأن the trend is now moving on to let's say emerging market ex China, because China, we know it's a huge the Chinese, we know that you are a huge economy that we cannot avoid. So the people is let's say seeing China as a different market and an entity by itself. Before starting, I'll introduce I hope I pronounce it very well, Mr. Mark Bint Schedler.
Perfect.
Yes. Mr. Mark has 20 years plus experience in strategies in emerging markets. And I'd like to introduce His Excellency, Dr. Tissi Yauna, yes, Balmali. He's the ambassador of Kuwait since 22, if I'm not mistaken. And as well, he's the co-chair of the Swiss-Kuwaiti platform, promoting business and collaborations between Kuwait and Switzerland. So, Your Excellency, if you don't mind, we could have like a 5-minute introduction before we get to start our lecture, please.
Thank you very much. It will be 2 minutes, not 5, don't worry. No, thank you very much. I'm very happy to be here tonight with all of you. As you mentioned, it's almost 2 years here in Kuwait. I arrived the last day of May 2022, and immediately I realized how strong, how long-standing and beautiful is the friendship between Kuwaiti people and Switzerland. I was impressed, actually. I didn't know that it was so deep and solid, and I must say I also understood that the Swiss banks are one of the pillars of this friendship. So I think in both directions, the Kuwaiti people, they like the Swiss banks, and the Swiss banks, they like the Kuwaiti people. And specifically tonight, the Swiss bank Vontobel, I was also impressed to observe the special relations that they are cultivating with not just the clients, but also the institutional level. They have a dialogue at the institutional level, and it's very beautiful also to see tonight that they also have this beautiful cooperation with the distinguished Kuwait Economic Society. So very happy to be here, and the topic is very important. Myself, I don't know if I can tell, but I was buying a Chinese car 7 months ago, and I'm very happy. So it confirms that the market is growing, the presence is important. I don't want to promote now, but I say I'm very happy. Now I can share the details after, which brand, etc., but only privately. So thank you very much for being tonight here with us. Thank you.
We'll move now with Mr. Mark and start our presentation. And please mind if I interrupt. So please, the floor is yours.
Thank you very much, Haya.
No problem.
Good evening, everyone. I feel very honored to be on stage here tonight. I heard that I'm one of the first foreigners to speak here. So there's a lot of pressure, obviously, on me, especially also with this very important topic, I think. And what I would like to do tonight is to share with you some of the insights, some facts, and also I would like to share with you what we discuss with international institutional clients, so how they see China and how they want to invest in China also going forward. I would like to split my presentation in 3 parts. So the first one I will talk about the unprecedented rise of China, so the success story of China. I would like to show some charts on this. Then we will talk quickly about how you can approach this as an equity investor. And finally, if we have some time, I would like also to look a bit ahead, to give you a bit an outlook and also show a bit how the dependencies are between the different countries and how they could also develop over time. I really would like you to engage, and I thought we do something new here, new technology. So please take out your mobile phones. Normally you don't do that, but now you're officially allowed to take out your mobile phones. I would like to do a quiz with you. So if you can please scan the QR code here. So what is the quiz about? It's rather technical, but I try to do it not too complicated. And the background here is that many people think China is not an emerging market anymore because of the size of the country and also because of the size of the stock market. And obviously there are very, very clear rules by MSCI, so the company that manufactures these indices. And I would like you now to say whether the things that are written here about the position of China, whether they are right or whether they are wrong. And then we look at it together. So first question, with a combined market capitalization just over 11 trillion, the Shanghai and Shenzhen stock exchanges are the second largest behind the US. So Nasdaq and New York Stock Exchange combined. Do you think this is right or wrong? So 73% said right, and obviously yes, that's the correct answer. The second largest one. Before Japan, I think, right now. Let's move to the second question. China's gross national income per capita has risen in the last 30 years from US dollar 350 to US dollar 11,880. Nevertheless, it's only the 60th place worldwide. Do you think this is true? Also, in determining whether it is an emerging market or not. China's share of global GDP growth is expected to account for 22.6% of total global growth by 2028. Is this important when we determine the emerging market status of China? So the answer is right, but it doesn't really matter whether it's an emerging market country or not. So that one was a tricky one. And the last one, since 2001, access to the stock exchanges on the Chinese mainland has been gradually relaxed. Nevertheless, the market is not yet freely accessible. Sorry, here are some double words in there. So yet, the market is not yet freely accessible. Is that important when we determine the emerging market status of China? What do you think? Is that important for investors or not? Yes. Now, show the right answer. Right. Good. So you all have very good know-how, probably also many finance people among you. So thank you very much for that engagement.
Thank you.
I would like to start here with some charts. And I mentioned before that China had this unprecedented rise, and most likely all of you have heard this figure. So what I show here on the left-hand side is the income per capita, how this has developed since 1970, compared to the world. So China is the black line, and the world is the blue line. And this is something which really has never happened so fast. So to put this a little bit in context, 1970, the income per capita in India was more or less the same like in China, around 120 current US dollars. And now you see it's around $12,000. So that's comparable to Mexico or to Malaysia, if you wish. However, Mexico and Malaysia back in 1970 were already 3 to 7 times higher, or the income was 3 to 7 times higher than China's income. So this is something we have really never seen before. And China also has become, within a very short time, one of the largest global economies. Obviously, it's number 2 now. I think early 80s it was kind of number 8. So this is also something we have never seen. However, I think what many people don't know is that back in kind of the 15th to 18th century, China was already the largest economy in the world by far. So before the Industrial Revolution, China was the biggest economy. And this is, of course, also the ambition China has to become again number 1. The right-hand chart here shows you how China has done this. And also, if you compare China to other economies, then China is a country that likes to trade. So they have a very, very high share here of imports and exports. And China has become kind of the factory of the world, the manufacturing hub. Of course, this was also thanks to the very young population they had and the population growth. So there was kind of cheap workforce available, which enabled China to reach that position. China is also different with respect to some other aspects of the economy. What you see here is on the left-hand side, how the GDP is generated. And you have there the gross capital formation, which is kind of the fixed asset investments. So how much money does the government, the private sector, put into infrastructure or also real estate? And you see the black line is China. It's much, much higher relative to the other countries. And that means also, you see that on the right-hand side, that consumption is much lower. So the economy does not depend that much on private consumption. So that's kind of a key difference. That also means that the real estate sector in China is by far more important than in other countries. Just to give you 2 figures here. 24% of the GDP in China is related to the property or to the real estate sector. That's a very, very high number. The others are somewhere around 5, 6, 7, maybe some countries around 10 or so. And also what this means is that 70% of the household wealth is in real estate. So real estate prices or real estate price development has a very, very important role in determining the wealth of the Chinese population. Maybe here, just to give you another number, you see China is up there around 43%, I think now in terms of the fixed asset investments. We all know what happens across the border, Saudi Arabia, also huge infrastructure investments. But currently they stand at only 26%. So I think this gives you a bit an idea how much China did in terms of infrastructure. And I think many of you probably have been there. It's everything very new. So the whole train system, the roads, internet, everything works now through smartphones. So it's not the technological level that we expect from an emerging market. But obviously there are also some challenges ahead of China, and I would like to name here a few. So the first one is, of course, the aging, or I think you can even say the overaging of the population in China. You see on the left-hand side that India has already overtaken, in absolute terms, China. And you also see there on the right-hand side how big they are, China and India, compared to all the other countries. The countries that have the highest population growth right now are all sub-Saharan Africa. So countries like Congo, Benin, Chad, I think population growth is around 4%, and that translates into 6.5 children per woman.
6.5 children per family.
Yes, that's a lot.
That's a lot, yeah.
Yes. I think Iraq is also quite high, and Yemen. And I think the first European countries, Ukraine around place 70 or 80 or so. But it's really sub-Saharan Africa. So this is where population growth is. So they have a huge problem going forward because the workforce is not anymore there. And of course, you also have to finance the elderly people, so the retirement of these people. And this money, of course, has to be generated first. And this goes a bit hand in hand, what I tried to show here. Economists often call this kind of the middle income trap. And so what does that mean? You see on the x-axis, the GDP per capita relative to the US. So how rich is a country relative to the US? And obviously, that's kind of the benchmark. That's the goal you have to move more to the right side. Huh? And on the y-axis, you see the CAGR, so the compounded growth of the GDP per capita. And obviously, what would be perfect? What's the goal? It's a flat line from left to right at a very, very high level. Now, this is not possible. Huh? That doesn't work. The growth has to come off the more wealthier you are. But the problem here is that the China line comes, let's see whether this works. The China line here comes off a bit too early. Huh? So that the growth rate is not high enough to reach this. And China obviously has recognized this. They would like to do things. They want to reform the country. They also want to lower the cost of living of people. This is what is called also the common prosperity. And that should allow China to increase their growth rates again and move more to the right. Then I think a topic that everyone can read every day in the newspapers. Huh? Major trading partners of China want to reduce the dependency on China. Huh? Because the ambassador before mentioned Chinese EV cars. So I don't know whether you know this, but 40% of worldwide rare earth reserves are in China. So China has a very, very dominant position in this. And of course, other countries depend on China. So that's not easy. Huh? If you want to do the green transition, you still rely on China.
Yes. So it is a big thing.
Yes. But of course, there are other things. Production of medical goods, or let's say things which are a bit lower technology, huh? Or also in the high-tech space. Of course, there, countries like the US or also some European countries see that as very dangerous that China is their major trading partner. So they want to reduce that dependency going forward. And what is the result of that? You see it on the left-hand side. So this is the foreign direct investments into China. And you see this has almost collapsed, I think we can say, since the COVID pandemic. And of course, other countries are on the rise. Smaller countries like Vietnam, Malaysia.
So those are the substitutes, let's say.
In a way, yes.
In a way.
Yes.
Let's say they're shifting to diversify into those countries.
Yes.
Okay.
But we don't really have enough time to go into this.
Yeah.
But it's very, very interesting. And we see this when we look at companies. So the companies that open up new factories in India or in Mexico or in Vietnam are often Chinese firms. Because it's not so easy, to just open up a new factory. You need to move the whole supply chain. And in certain sectors, they're so dependent. It's a very specific technology you need that takes years. So it's just, okay, yes, you ask the Chinese company to open up a factory in Mexico. This is kind of the reality. And I think this is a reality the newspapers normally don't tell us. So what is China doing to kind of overcome these challenges. And this is just kind of two answers to that. I mentioned one before, so they want to reduce the cost of living of people. So education costs were too high, all these post-school tutorials for the kids, but also, of course, housing prices have been too high. And there, the government has acted since more or less summer 2021 and tries to lower this. And this, of course, was kind of a harsh crackdown because it was also rather unexpected to global investors that this happened. And it's probably also quite often not yet understood why this is really needed. But China has this long-term perspective, and if you want to grow, remember my chart I had before, they need to move to the right side, so this is one of the things they have to do, although it hurts right now. And another one, I also don't here really go into the details, it's called the dual circle economy. So this is about reducing their dependency on exports, so that you have more consumption in the country and also self-sufficiency, but also that you become stronger in certain areas. They call this the star industries, like semiconductors, biotechnology, the EVs again. So this is what China tries to achieve. Then another challenge, and I haven't really touched this yet, is China has a lot of debt, has built up a lot of debt in the recent years. Not only public debt, but also private debt is very high. I think right now it's about 70% of the GDP is private debt. And that compares to a level of 60% when Japan peaked in the 80s. And this is why we call this the risk of a Japanification of China. So can the same happen? And the risk is obviously, if your debt is too high and you have to pay down this debt, then you cannot consume. So first, of course, is reducing your mortgage or whatever, pay your loan down, and you don't consume. And that's, of course, a risk to the economy.
Yeah, so just to elaborate on that, so whenever the debt is high, consumption goes down, and that is what is affecting that is what, let's say, concerns about that.
Exactly, yes. And what you do not want to do is to enter kind of this deflationary spiral, which is very, very dangerous. And that's anyway something which is a bit there, and which also has to do a bit with the model of China, the economic model, because it's very centrally orchestrated, I would say. It often leads to overcapacities in certain areas. And again, I come with the EVs. So, I don't know. No, a normal car, okay, good. But prices for EVs have fallen dramatically because there is huge overcapacity now. And China does not only produce the cars, they also produce the machines to assemble the batteries, or they extract the lithium for the battery. So the whole value chain sits there, and that had a very negative effect at the moment. Probably also you remember the same thing that happened about 15 years ago with solar panels. But I think, without going here into too much detail, it's pretty balanced. So China is probably able to manage this. We won't see a Japanification, because there are also quite some notable differences to the situation Japan had back in the 1980s. Then challenge number 5 is policy. And also how China acts with these policies, or kind of the regulation of the private sectors. I briefly have touched upon this before with the education sector, but we also have it in the healthcare sector, or in the internet sector. Everyone probably knows this, what happened to Alibaba and Tencent, the gaming companies. But I think this is nothing new. If you look at the chart here, the chart shows you that China regulates in cycles. So sometimes they tighten, sometimes they ease. And I think this is also something you need to anticipate as an investor. And that's also very, very different to Europe, for example. In Europe, the regulator watches, defines rules, and then company can start to do their business within the bandwidths defined by the government. And China more let the market do, let the market develop, and then they come in and correct things. I think this is also something we have to know. What international investors often fear is the risk of policy errors by China. So that, let's say, what they do is not right, and they have to recorrect that again. I think you can compare it a bit to what happened with the COVID lockdowns in China. Was it really necessary to have these lockdowns for such a long period of time? I skipped this. This is about energy intensity in the interest of time. But this is also obviously a big problem. So they have to import a lot of energy into China. Nevertheless, we talked a lot about this unprecedented rise. And we talked about quite many challenges they have had. But I think one thing we should not forget, and this is how big China is. And you see here on that chart that China contributes still. We have seen a slightly different figure before, but it's almost 20% of global growth comes from China.
That's huge.
It's huge. And this is, so if China manages to achieve their growth target, right now it's 5% or around 5%, or if I'm right, they changed it slightly, the tone, so around 5% now. Then of course this is going to last for quite some time. So don't underestimate China. So how to approach EM equities? And before here I show you some solutions, I quickly want to draw your attention here to these weights of China in the benchmark. You see on the left-hand side the current weight of China in the benchmark, and China is the pink part. And here we have stocks which are listed offshore. So that means stocks that are either listed in Hong Kong, Tencent is such an example, or also stocks that are listed abroad. So for example in the US, like Alibaba had one, they moved it now to Hong Kong, JD for example, or Trip, the travel agency for example, is also US listed. And then you have the onshore part. So these are the companies listed in Shanghai and Shenzhen. And these are way more companies. This is kind of the big interesting pool. But you see, it's only 4%. And now you ask yourself probably, why is this? How can such a big economy and so many companies only be 4% in the benchmark?
Yeah, why? Why is it only 4% with all those huge mega companies?
That has to do with the questions I asked you at the very beginning in the quiz. So because the market is not yet fully accessible, and for example, because there are no derivatives, or it's also a very special settlement cycle for the specialists among you. So it's T+0 or T+1, so it's a bit more challenging to trade Chinese equities, and also you need a license.
Entering barriers.
Yes.
Yeah,
yeah, I can't buy Chinese equities as a private person directly. You need a license. But of course, also they have done a lot with this Stock Connect program, for example. So they modernized this. They also want foreign investors. So why is it so low? Because there is a so-called inclusion factor. And the inclusion factor is only 20%. So only 20% of the market capitalization of these companies or of these stocks is counted for the determination of the weight. There was, since 2019, it's 20%. 2018, it was only 2.5%. So somewhere, I think this will go up to 100%. It should. And this is, we as an investor community, we can determine this. So there's a consultation by MSCI where we can say, yes, we want to increase that factor. But I think it's very clear. This is America-dominated or US-dominated, so probably there are also political forces against increasing that weight of China. If it would be 100%, look at the right graph, so then the weight of China would be 40% in the emerging market index. And so this is kind of the fair representation of China in the benchmark.
Mr. Mark, before you go to this slide, we're about 5 minutes to end the discussion, so how do you want to manage this 5 minutes?
Yes. So what are the options here? Just to here show you a few. There are investors that recognize that potential of China. Also, they recognize that it's underrepresented. They recognize they can achieve nice returns. So they want to increase China in their portfolio. So this is what we see. We see that especially also more in the Middle East countries, I would say. People are more open. But of course, if I talk to a US investor, then it's the opposite. So they want to reduce China for political reasons. Huh? So for example, some public entities in the US are not allowed anymore to invest into companies which belong to the Chinese government, for example. Huh? And I think what is good, most of the clients that we see, or most of the international investors, don't do anything. They just watch. So the status quo. Because China has such a big weight in the index, they don't want to miss that. So it's this fear of missing out. Huh? So they want a return, they are skeptical, they ask themselves questions, but they want a return. Huh? Very interesting.
Nobody wants to miss out the rally.
Yes. What you see here is all companies in the All Country World Index. So these are all companies listed on the stock exchanges worldwide. And what you see here on the left-hand side is, if we look now at the companies within that index that have the highest profitability, the 20% with the highest profitability, and we look at which country or which region they are coming from. And what you see there is China, the black line, has increased a lot. So China has done a good job. Private companies, and probably also increasingly the state-owned companies, they are profitable, and they are more profitable. So despite all these risks, these discussions, they are interesting.
China's doing well. Within all the pressures.
Yeah, they did well for a very long time. The last 3 years, we all know, were not that good if you invested in Chinese equities, put it like this. But the entry level is also low now, so it's probably also attractive. I skip this, and maybe just here some key takeaways. So China is an unparalleled economic success story. I think everyone agrees to this, even the Americans. We also know that as a result of that, because it was so fast, China is in a way underrepresented, but at the same time also very dominant when it comes to the world of equity in investing. Huh? And so there is this assessment going on, with or without. And to us or to me, there is no right answer. So it's often kind of a belief question, or it goes back to your question before. So there is a regulation in some countries that go in that direction, and others investors go into the other direction. And probably this is going to last also a bit. Yeah? And I think the role we have as asset managers is, of course, to offer the full suite of products or strategies, so that everyone can find kind of the thing that fits best for their own investment frameworks or policies. I hope I'm on time.
Yes, you're absolutely on time. Thank you so much, Mr. Mark. I think we want to open, like, if there are any few questions regarding China, or if you want to see anything.
Actually, my first question regarding the homogeneity and heterogeneity of EM. You are gathering them in one block. According to the IMF, we have around 31 Asian emerging markets, and we have around 15 EM European emerging markets. Is it possible to put them in one basket, regardless their huge differences in their economic characteristics? This is one issue. By end of the day, all emerging markets, they are net exporter of goods and net importer of capital. This is no difference about it. You have kindly mentioned the MSCI EM index. But if we go within the EM capital market, we see that China equity market is around a third of the global emerging market index within the EM. So an investor who buys an emerging market equity tracker is also invested in China. Yeah. This is, if we gathered a number of economic indicators, for example, you have kindly mentioned the real growth, and what you mentioned is right, between 23 to 25 is around 5%, the rate of growth of China. But if we compare it with the United States, it is more than double, 1.5. Yeah. Then the rival of China in attracting the equity, the equity and bonds of emerging markets. If we talk about real exchange rate, almost taking into account that 20 is equal 100, almost the same. I mean 106, 103. There is not much of difference as far as the real exchange rate as a main factor to attract or not attract capital inflow. But if we talk about...
I will interrupt you now.
Last
point?
Yes.
Because I want to put the real...
Current account, China is prominent in such regard. It has a huge surplus. If we compare it with the European emerging market, it is negative. If we compare it with Asian, it is surplus. If we compare it with US, it is negative. Such indicators, I have many indicators, inflation, net savings. How can we make use of them and draw a number of conclusions regarding China and emerging markets? Thank you, sir.
Thank you so much for this remarks. You can
very good questions, and obviously very, very important points that you mentioned. Let's put it like this. The equity market has never represented kind of the full economy. Neither in Western markets, the US or in Europe, nor in emerging markets. And this is also something which we know as the China equity market paradox. So the Chinese equity market never reflected this economic boom that we have seen before. So you never participated fully in that economic growth. And the reason for this is kind of there is a dilution of profit growth, because there were emerging markets need a lot of capital, as you correctly said. So the companies constantly have to increase their capital. And with that, of course, you have to share the profit you get as a shareholder with other investors. So the profit per share goes down because there is this dilution effect. And the Western countries, they do the opposite. Look at the US. Companies have excess cash. They do not invest because also there is not so much economic growth. So what do? They do share buybacks. So that increases the profit per share. That's a very, very important effect I think we have to know when we look at emerging markets. What that does also mean, and of course I'm very biased because I work for an active asset manager. So I think the index is not right. But of course everyone follows that index, it's the benchmark. But I think we could discuss for 2 hours whether the benchmark is the right thing and also how it's constructed. And the other thing is also, we believe it's not the right thing to come top down. So it's not interesting to say, do I want now to invest more into Saudi Arabia or Kuwait? Top down. Yeah. What we want to do is we want to find the best Saudi companies, and at the same time we can also invest into the best Kuwaiti companies. Because obviously in every country there are companies which do not depend that much on the macroeconomic development. And FX is obviously always a big problem, yes. So normally EM does well when the dollar weakens. That's something I think we all have to live with.
I think since the foundation of the People's Republic of China, China has been always facing various kinds of challenges and difficulties. And we overcome the challenges and solve the problems by development. For the time being, or nowadays, we understand China is facing some big challenges. And I think also the world economy is facing some big challenges. That's why China hopes to cooperate with other countries to promote bilateral investment, bilateral trade, and to find a better way to solve the challenges faced by the people or by countries all over the world. And just now, you also mentioned, the less export of high-tech products from China in recent years. When I was in university, I learned Western economics, and in my mind, based on the competitive advantages, countries do the trades. And I think even now, China has developed a lot in the recent years, but for the export of the less export of high-tech products from China, is not the reason is not from China. The reason is the less import of some high technologies from outside. If there's no or less control of the export of high technology from other countries, I think the export of high-tech products will continue. As you said, based on the Western economics, the economy or the trade should be based by the market, driven by the market. That's why the Chinese government also always hopes the countries all over the world can have less control of the international trade to promote the global development of economy. And just now, based on the graph in the PPT, I think you said there might be a downward trend for the Chinese economic development. Chinese government has paid much attention to the challenges which is facing China, facing the economy is facing. And we are doing all the best ways to solve this problem and to maintain the development trend. We understand the development rate is comparatively lower than the previous years, but we are continuing at a reasonably or comparatively high speed with other major economies. And China also pays much attention to the quality of the economic development, not only the speed of the economic development. That's what I want to share with you. Thank you all.
Thank you for sharing those
Thank
points.
you.
Thank you so much. Thank you so much. Thank you so much. I think we came to an end. Thank you for making it a very interesting and interactive session. And we thank you, Your Highness, Mr. Ambassador. Thank you so much, the Chinese and the American. Thank you so much.